You will find the link to crypto learning mind map in the description and pinned in the comments below. Most people assume crypto is either doomed or about to explode forever. But what if both views are missing up the point and that mistake could cost you everything? In the next few minutes, I will show you the single idea investors misuse when they bet on a super cycle and the hidden sign that tells you when it is about to break. Stay with me. Today, you will learn what a crypto super cycle actually claims, why experts swear by it, three real world arguments that destroy the idea, and a practical checklist you can use before you risk a single dollar. Plus, I will reveal one secret metric almost nobody watches but that predicts cycle crashes. Watch to the end and you will have a plan, not a prediction. If you want clear crypto lessons without the buzzwords, hit subscribe now. I post short practical ideas, videos every week to help beginners avoid costly mistakes. First, people throw around supercycle like it is a law of nature. But what does it actually mean? A supercycle says this market is different. The rally is not a normal boom bust. It is a long structural uptrend driven by fundamentals like mass adoption, changing money, supply, or institutional flows. Think of it like a decade long tide lifting every boat. And analysts use terms like post 2017 structural demand or digital reserve asset to justify it. Imagine housing in a new city. Early growth looks explosive. A super cycle says the city becomes a global hub and prices keep rising for years. That idea feels comforting. It promises you can hold through volatility and never miss out. That promise creates greed and sometimes denial, but comfort can be dangerous. In the next section, I will show three reasons that comfort is often wrong, starting with a factor almost never mentioned. Why are so many smart people convinced? Let us unpack the psychology and data behind the hype. Three main drivers explain belief in a supercycle: narratives, macro flows, and network effects. Narrative creates momentum when everyone believes Bitcoin will be digital gold, capital follows. Macro flows, low interest rates and printed money push investors to risk assets. Network effects means more user drive, more utility, which looks like unstoppable growth. Remember 2017? Fear of missing out spread faster than tech adoption. In 2020 and 2021, institutions entered and people read that as confirmation. That mix triggers two powerful emotions: fear of missing out and the hope that this time it is permanent. These drivers are real, but real does not mean invincible. Next, I will show three concrete counter arguments that cut the legs out from the under a supercycle thesis. Counter argument 1: markets still have cycles. Even big structural stories can fail. History shows cycles within cycles. Stock had long secular trends that paused, reversed when liquidity or sentiment changed. For crypto, structural narratives clash with leverage, derivatives, and concentrated holdings, element that can amplify a crash. Large holders and exchange liquidity can cause cascades that look like an end to a super cycle. In 2013 and 2015, Bitcoin crashed despite growing adoption. Why? Liquidity squeeze and panic selling outpaced the adoption story. That is scary because if you assume permanence, you may hold through a wipeout and lose years of gains. Next, I will explain the second argument, and it is the one that destroys simple narratives. Counter argument 2: macro policy can flip the script overnight. Interest rates, capital controls, regulations, and fiscal shocks are outsized risks. A supercycle relies on tailwinds like liquidity and institutional demand. If central banks tighten or large economies crack down on crypto flows, that tailwind becomes a headwind. Even a single major policy shift in a big market can trigger global repricing. When rates rose and leverage collapsed in other asset classes, risk assets dropped rapidly. Crypto's sensitivity to risk on capital makes it vulnerable. That uncertainty brings fear. Hope can turn to panic faster than adoption grows. The third counterargument is even more subtle and it lives inside crypto itself. Counterargument 3: crypto's own mechanics can break a supercycle. Inside crypto, you have tokenomics, inflows from yield products, leverage in derivatives, staking mechanics, and concentration among holders. Some projects emit tons of tokens over time, and sellers appear even as demand grows. Liquidity pools, algorithmic experiments, and hacks can create negative feedback loops. Network growth alone does not fix poor token design or centralization. A token can have rising users but still dump because early insiders sell the unlocked supply. That is the hard truth. You can believe in the technology and still lose money because of design and incentives. So, those are three big counters, but there is a hidden metric most people ignore, the one that predicts when narrative driven rallies are about to falter. Halfway through, here is the secret metric gurus do not talk about. It is not price alone. It is net new risk adjusted capital flow into the ecosystem measured by institutional flow signals, exchange net flow, retail leverage, and token vesting schedules combined. In plain language, are new reliable long term dollars arriving, or are short term levered bets inflating the price? Imagine two rivers feeding a lake. One is steady mountain melt long term capital, the other is a storm drain that surges and recedes levered retail and derivatives. A supercycle needs the steady river. If most inflow is the storm drain, the lake will dry fast when the storm ends. This means the obvious charts lie. You could watch a rising price but ignore the shallow base underneath, and that is when people get surprised. Next, I will give you a practical checklist to test whether you are in a real supercycle or just a noisy rally. Checklist time: 5 questions to ask before you bet everything on a supercycle. Number 1: who is buying? Institutional custody flows versus retail exchange inflows matter. Number 2: token supply dynamics. Check locked, vested, and emission schedules. Number 3: leverage and derivatives. Watch funding rates, open interest, and margins calls. Number 4: regulatory momentum. Look for policy shifts or clarifying guidance. Number 5: real utility adoption. Ask if user activity is paying for the network or just speculation. For each item, know one red flag. high retail inflows with rising open interest, large upcoming unlocks with little real demand, sudden regulatory warnings in major markets. Use this checklist to avoid betting on hope. It will not make you safe, but it reduces the chance of catastrophic surprise. If you still believe in long term crypto, here are three ways to act that balance both belief and risk. First, DCA plus size caps, dollar cost average, but cap your allocation relative to net worth. Second, staggered positions with stop ranges. Scale in and plan where to reduce risk if funding stress rises. Third, hedging. Use small options positions or hedge with stablecoins or treasury assets to buy the dip with calm capital. These strategies convert hope into a plan. They keep you in the game when things swing. The biggest truth, a super cycle is not a guarantee, it is a hypothesis. Your job as an investor is not to believe or disbelieve, it is to test the hypothesis constantly. Treat every bullish thesis like an experiment with data points, capital flows, policy signals, tokenomics, outcomes, and market structure. When data contradicts the hypothesis, update position sizes fast. That simple discipline, test, measure, adjust will protect wealth far better than unwavering belief. That discipline turns fear into a skill. It keeps you emotionally steady and it separates gamblers from long term builders. If you want more clear, practical crypto lessons, not hype, subscribe now and turn on notifications. I break down real world strategies and signals every week so beginners can act without panic. But before you make any new trade, watch the next video where I reveal the most expensive investing mistakes beginners make and how to avoid them. Click now because I could it could save you more than this video taught you. See you in the next one. Trade smarter, not louder.